Hey, I'm gonna make a video. I'm not sure how this is working. I've got a little bit of noise in the background. I hope this is okay. And this time, for once, a couple of people have been asking me questions lately. It must be a time for interviews or something. If you go to, if you get these resources and go to folder number B from chapter 1. So go to chapter 1, folder number B, and then this action noise is coming out of order. I'm going to try to talk about two tests. Just a minute. Okay, and now I received this test for a wind farm in Suriname. I happen to be in Suriname right now. It's actually not really in Suriname. And I'm going to go through this test in the subsequent video. I'm also going to go through another test. They don't really tell. Oh, it's this supposed to be a hospital with availability payments. Okay. I'm not sure if I'm going to do these kind of in the same order. I mean, in the same time. I almost will. This test, the person said, "Oh, this test really isn't that bad." They actually gave you quite a bit of time for this. Uh, they whatever. It's a wind farm, costs 1.5 million per megawatt, 1,500 per kilowatt. They want a little advance payment, and they want maybe you to do a little bit of monthly construction, and then they gave some things in a yield, which is kWh per kWp. It's not, wind is really not, I've never seen it used as kWp, but whatever. For some reason, a P75, God knows why, now a P90. Some operating costs, and the project debt is 15 years, and there's a corporate tax rate in Suriname, and some depreciation, general instructions. This is where I'm going to start going crazy. Three financial statements. Why, screw you! It's project finance. Financial statements can be thrown together at the end, and they're easy. It makes me vomit when I had to hear this. We had this meeting, and he said, "Oh, all my analysts are really good. They can do financial statement. I'm gonna throw up." Okay? When the three statements are complete, this implies that the three statements are not just an output, then compute the outputs. That's so wrong. The models will be evaluated on the consistency and flexibility, blah, blah, blah. Okay, fine. And then compute project IRR, equity IRR, fine. Project IRR, I suppose, after tax and pre-tax, equity IRR, money multiple. Oh my God, that's a goddamn payback period. And I suppose we could compute it on whatever we want. We're going to add up all the costs and divide it by the initial cost. Dividend IRR, I have no idea what they're talking about, and I'm not going to look it up because I don't know the difference between a dividend IRR and equity IRR. I suppose if there was perhaps a shareholder loan or something. Exit IRR, assuming exit in 3 years at the buyer's IRR 7% optional. That's somewhat interesting. And then it says calculate the equity value after 5 years thing. Well, look, if you compute the equity value using something different than the buyer's discount rate, and maybe the buyer's discount rate is going down, and that doesn't say it's equity IRR. We must be assuming it's equity IRR. And if the current IRR is a lot higher, this will give you a different kind of, oh God, I hope this is working okay. Calculate the enterprise value. Okay, and to compute the enterprise value, all we need is the cost of capital, and we have it right here. And then these idiots, these goddamn idiots, use the WACC and the cost of equity based on ungearing and regearing. Oh my God. And I've seen more and more people do it. At your market risk premium 4.8%, bullshit. A country risk premium 5% for Suriname. Oh, well, this was not really for Suriname. And to be able to model a construction delay of 1 year, okay, and be able to do a little bit of sensitivity analysis. So before I do this case, I'm going to tell you why I go crazy about those WACC issues, and something very basic. They didn't ask for a sensitivity analysis on the lifetime of the plant, which they said was only 20 years. I'm going to go through some theory, which I promised before. So this video with that kind of introduction is really about project finance theory and why three-statement models are crazy to worry about, why WACC changes, and why ungearing and re-gearing the WACC is horrible, and importantly, what you can do just about IORs. So, and I had kind of said I was going to do this, and I was going to practice this for this class I was doing. And I didn't have to because I never got there, and they made the class a little bit shorter. So I'm going to just discuss some of these advanced topics, and I don't give a crap if you see the okay, the real idea of this video is to go through a couple of what I think are a little more tricky and advanced, frankly, more interesting topics. Okay? So I'm going to talk about a subject that I've talked about a little before, which is the Africa, I call it the Africa IIR plan, where if you have 30 years to 100 years, you got almost the same IRR, the cash flow is wildly different. MIR doesn't work, maybe a risk premium method works a little bit. Okay? I'm also going to talk about this issue of changing, I don't even want to call it WACC because I used to call it what? Absolute complete breath. What? Absurd complete profit, I should say. If we assume the WACC stays the same, which is like what they had in that stupid test that I just opened. But I'm going to start with the last, which is this business of unleveraging and re-leveraging the WACC. And I told you, I vomit when I hear three-statement modeling in project finance. I don't know what. Maybe just really bad diarrhea. Oh my God, when I hear this unleveraging and re-leveraging the beta, this illustrates what's the problem with the thinking about project finance these days. Here's the basic thing, I just wrote it up here. If we have a low-risk project, we get more debt. We get longer debt. And maybe we get a lower interest rate, maybe not. Probably not, because the project finance is supposed to be geared to 3.5% IRR. Now, my friends in Suriname don't get that because they had problems with the IMF. They have a whole big population of 600,000 or something. But if we have a high project, we get lower debt to capital. So the debt to capital has already fixed the risk adjustment. Maybe you get a shorter term, and I purposely said the equity IRR is about the same. So this whole business of re-leveraging and unleveraging the WACC just doesn't work. And then this just absolutely horrible crap that goes on where we don't have any traded project finance or pure project finance, or very rare. And the business, all you need to know is this asset beta is the debt beta times debt to capital plus the equity. Now, you could put taxes in like a guy named Robert Hamada did. And I remember sitting in his office. Oh, there was so much smoke. He smoked all the time. Ooh. This whole tax thing was whatever. And then we could even argue, is the debt beta, which I used to argue, which was ridiculous. Can we get that kind of from the credit spread? If you do that, the debt beta looks really pretty high. But the typical thing is, just ignore the debt beta because it's really kind of true. The whole idea of debt being a portfolio where you can diversify the portfolio is kind of a silly thing. So that's what typically you might do, maybe not. Then you can restate that as the equity beta is the equity to capital plus the asset. And what am I doing here? I'm just rearranging it and get the equity beta as the asset beta times the capital to the equity. Very, very simple. So let's say we have some utility companies, because we can't find anything else, and they typically have a debt to capital ratio that's not anything like project finance, and it shouldn't be, or it should be. First of all, they love to have a lower debt to capital ratio so they can go into the regulators and show they have a higher WACC. It's all a conspiracy, I think. I'm not a conspiracy theorist like these assholes, but there's kind of a natural incentive to have a not too high a debt to capital if you really looked at things carefully and took the utility companies and did some kind of regression or correlation between the debt to capital and the equity beta, you wouldn't find anything. Bullshit, you just wouldn't. Maybe some companies that have done really crappy, so they have a high debt to capital ratio because they've been such bad performers, maybe you'd find a tiny little bit. And then you apply this thing to get the asset beta, and we have a really low asset beta, I think, in that stupid little modeling test. They said, let's assume the asset beta 0.4. Okay, whatever, wherever they got that. And then you go, where the heck am I? I'm looking through the PowerPoint slide. You go to this one and you redo it. So let's re-lever it. So let's say the asset beta is at 0.28. The debt to capital, we'll say, is in project finance 85%. That means the equity capital is this, and then you take the reciprocal, the capital to equity is 1.86. And that gives you the equity beta. And you're saying the cost of equity is really high. You've got an equity beta of 1.2. If the asset beta, if the debt to capital, because you've got a high risk project, you go through that exercise, and then the same thing, the equity beta is 0.7. This is all such rubbish. Because in the real world, number one, coming up with cost of equity is so impossible. And basically the real answer is that we look at the risks and we see that there are mean reverting risks, and we really think about the equity risks versus the debt risks. Okay, the debt has a downside risk, no upside. The equity has an upside from refinancing. It's more like almost a convertible bond in project finance. And in the real world, the equity kind of premium might be a couple of % above the debt cost. I acknowledge that I don't think it should. That's kind of being a little overstated, perhaps. But that's the way actual transactions work. So when we go through this horrible test, when they said here, they gave us a buyer discount rate of 7%. Well, And that says, assuming 3 years after operation, which 3 years of history on operation is a very nice period. And we could, if if we use the a 7% versus, I don't really even want to compute this. I can hardly do this. If we said up here that where's the debt to capital? Come on. 70%. Where's the come on? 70%. Again, 70%. So we say the equity to capital is 30%. So you go, and I need to find a calculator. Excuse me. Why can't I find a calculator? Oh God, I'm gonna play. So let's do this. Oh God, it's okay. And so capital to equity is something like equal to 1 divided by the 3. So we're going to take this just a minute, 3.33, and then I got to remember my stupid formula. So equity-based beta is the asset beta, which they gave us 0.4. 0.4 times our capital to equity. Beta on the equity is this. And then 1.33. And then if we keep going, let's look at the rest of the test. Then they had this, I think, way too high. But whatever, this is kind of damn that other disgusting person. And if anybody says, oh, you're like a, oh, let me give you the biggest compliment ever, you're like a damn project. Oh, please don't ever say that. 4.8%. So let's take 4.8% times the beta, if I can find my accelerator. Equity market risk premium, 0.8%, and we have equity, and now I'm contradicting myself, but this is kind of interesting. Oh no, it's not. We have 6%. We're not finished. And then we have the risk-free rate, and the risk-free rate is 2%, I remember, which must be kind of an old case for COVID times. So the cost of equity is 6.4%, 8.4, a lot higher than the 7%. But then, oh my God, this, and it's not really showing up. Then they said the actual amount, this is the wrong one, is country risk premium of 5%. Oh my God. Oh my God. Oh my God. Another Damaradan bullshit thing. So then we're saying the country risk premium is 5%, and we get the total to be whatever, obviously early on. Okay. How crazy is this? How totally 13.4%. The actual that they told us, they didn't really tell us if it's equity, but I'm assuming it was 7%. That's such an enormous difference when you come to the valuation. And it would be great if somebody said, screw this test, I'm going to just put this test, and I'm just going to show you how bullshit your whole thinking is, and how if you start wanting people to make a beautiful little Excel model with all the great colors and the timelines and the right structure and the right inputs and the sensitivity, but you can't think about basic kind of project finance, what does it all mean? Let's go and look at another issue. So another issue is related to this, and that's this issue, and I totally agree that this is another problem with the IRR, is the IRR can, well, now I'm going into problems with the IRR. The IRR can't really account for changes in risk. I'm not sure the NPV calculation does that. Well, it maybe kind of. And here's what, I've done this way too many times. I mean, but this was at least in the test. They said we're going to go to period 3 and we're going to discount all the future, and they used equity cash flows, I think. And we're going to discount those cash flows because a buyer is going to be willing to buy this at 7%. And when you do this kind of analysis, all you do is put a sale date in. We'll put a sale date with a flag. We'll show off a little bit. And then you stop at the sale date. You put all the outflows and the sale date inflow. And what always happens, here's the IRR, as long as this IRR is greater than this discount rate. You notice I used a interpolate function to be really fancy. I wouldn't suggest doing that in a test because they'll freak out. But this says maybe in year 2, the discount rate went down to 8%, 7%. And this, when I say discount rate, this is the buyer's discount rate. And then all we do is take the net present of future cash flows. So we go up here, go forward, take the NPV calculation or XNPV calculation, whatever you want to do, and you get the value of the project, which I didn't put over here. Oh my God, I didn't put a little thing that says, here's the value of the project if we, no, yeah, I think that's right, if we sell it at different dates. Now, when you can just make a little data table and change the 7 to 1 to 2 to 3. By the way, that's what we'll do in this other modeling test that had this one was a little more confusing on the refinancing, and it had a refinancing every 5 years, I think. Is that right? So we're going to have to put a little flag in for the refinancing, throw a fee in, refinance based on this 1.2 times DSCR, and put a tail in. Oh, very good. They put a tail of 12 months, presumably for the end of the project. And maybe the refinancing after a couple of 5-year periods won't really give you that much. We can then try it with and without. That's a little more interesting, but it's really related to this business of selling the assets. Sorry about this. I was looking for an Excel file and it wasn't an Excel file. So you get out to this period 7, and you take these cash flows that you had to spend anyway, and then you get this discounted future cash flow. And I think we used the 7%, not the interpolated. I can remember maybe the interpolated. This, I should have shown you this. And then this 9% becomes 17.91%. And you can even do this ridiculous thing where you optimize the date of the sale. And that optimization depends on 2 things. It's always better, whenever you do this, it's always better to sell it really, really close by, even in year 4. When we had somewhere, maybe I did a little interpolation, 4 to 5, then you have a big, you have a big increase in IRR, and that's always because it's so much better to get money early than to get money later. So even if the discount rate doesn't change very much, if you sell it very early on, or when I say sell it, you could be selling it 50% of the project to a partner. So at the very end of the day, there was a wonderful lady I met years ago who said, this whole IR is BS because you can just give me an IRR, I'll give you whatever you want. And she had a point. But there's also a point that the declining risk of a project that really does occur, and the upside from refinancing does occur. There are upsides. If you have a project that's not on the upside, that's really in its downside case, you're not going to refinance and you're not going to sell it. Okay, you're going to be earning a really low IRR. So on the downside case, you have nothing. On the upside case, you have these two basic, and if somebody in an interview test asks, oh, what's the upside? You have those two basic upsides. And the other basic problem is, okay, we don't know exactly how we're going to sell the project, what the discount rate of the buyer is going to be, how we're going to refinance the project. So we don't really know any of this, so we shouldn't put it in. That's ridiculous. That's like saying, oh, I don't know what the oil price is, so let's make it zero. We're an oil company, okay? I hope you're not an oil company. Okay, let's talk about this Africa problem and then finish with this video. The other thing, I try to explain this IRR problem, and I go crazy when I hear McKinsey say the IRR doesn't work and we should use the MIRR, and I go even crazier when Professor from Oxford says IRR is bullshit at the Amsterdam Institute of Finance. I'm going to go have a bunch of drinks, and I'm going to say, IRR is bullshit. And they're all going to say, oh, you're such a great professor. IRR is bullshit. Maybe we should use NPV when we have no goddamn clue about what the equity cost is, and we put idiotic things like a 5% risk premium for a country in there. Oh, shit. Okay. So you understand why IRR has won. If you're talking about this NPV versus IRR, what a waste of time, by the way. But basically, some people say, use NPV with a discount rate, and then you can have a gigantic project with a little bit of a higher or lower cost of capital, and you get a completely different answer. Okay, it all depends on the cost of capital. Nobody wants to do that. No CFO wants to do it. They want to be able to compare different projects and see which one has a higher return. So back to our Africa projects. Our Africa project, we're going to say, has 100 years hydro project. And we're going to make a capacity payment using PMT, and that's another beef I have, and I'm sorry about yelling so much, but I don't even know what these words meant, like I am. I used to have to open the stupid books. At the end of those finance books, there used to be a table, an annuity table, and you'd look at the years and the discount rate, and you get the annuity factor, the PMT. And people are great at using, offset function and whatever. I don't know what kind of really fancy other functions, just showing off their functions, making absurdly long formulas, and they don't use the PMT enough. PMT is just a wonderful thing now. So we said, okay, let's make this capacity payment, let's let it inflate, and make it so it earns a 14% IRR, and then let's put a little timing thing here, and let's change this so it ends at 50 years or 30 years or goes all the way to 100 years. And when you do this, you can just accumulate all the cash somehow. I just accumulated this is just an accumulation. This is not the capacity payment I was wrong. This is the capacity payment with the PMT, with a little bit of adjustment for making it a real discount, right? I guess I put this cash flow, okay? That's how much cash flow you earn. If you make it 50 years, you earn about half the cash flow, less than half, I think, because of inflation. 30 years, you only earn this much. But the IRR is hardly different. This one, it's just not even different at all for about half the cash flow. I know it's future cash flow. And this one, it's a little bit more different. Okay, well, that's 50. That's half the project line. Oh, my God. And this one, it's really, really small. Now, you can, of course, say, that's future cash flow. We have to discount it. The problem is you're discounting at 14%. And everybody knows that that's the big problem with the IRR. And that means when you get way into the future, all of your cash flow is from reinvestment at this 14%. It just, the 14% overwhelms everything else. So we can use this MIRR, where the McKinsey would say, oh, use this MIRR, and that would sound really smart. And then this is supposed to be the cost of capital or something like this. And so we can find another project that earns 10% instead of this 14%. And then here's what happens. You get a number that's very much like the 10%. And if you put 5%, it wouldn't be quite as dramatic. You'd get a number that looks like 5%. And if you go 12%, you'd get a number that looks like 12%. So you're not getting to compare projects, really. All you're doing is comparing what input you used for the MIRR. It takes away the whole nice thing about the IRR. Now, here's what I suggest. Okay, I've suggested this elsewhere. Why don't we just put a risk-free rate in and take the net present value of all these future cash flows, not the total. So if this was 120 and this was 100, you'd take the NPV of this, let's say this was 103. You take this divided by that, you get 103, and that's the NPV. You take the NPV of this, or all of that, through 100 years at the risk-free rate. And we're looking for this risk premium. We're looking for this horrible thing they put here, this 4.8%. I want to see if I can make more than this 4% equity market risk premium that they talk about. Okay, I gotta relax. Okay, whatever. I'm not talking about solar power right now. Then we see what kind of premium you're earning on it. And then once we have this premium, it's over 100 years, we've got to spread it out. And I use the PMT at the risk-free rate. You could argue, is that really the risk-free rate? Should the premium, when we spread it out, should it be at the risk-free rate or something else? I use a risk-free rate. And then we compute this market risk premium. If we have the 30-year project, we're earning 10% above the 3.5, so we're earning about 13.5%. It's kind of like the IRR itself. It works there. But then as you go out longer and longer, it gives you this really big premium. This one would be 13 plus 3, 16. This would be much, much bigger premium. And I think we've answered a few things about the IRR. We're not dependent on this kind of arbitrary rate. We put a risk-free rate in, and we get some, I think, reasonably sensible looking results, and we are able to still compare projects. Now, this isn't going to happen, certainly not during my lifetime. If we do the same analysis with a European, maybe, hydro project that has 30, 100, we get a much bigger difference, and that's because we're using a bigger discount rate. But this really does highlight the fact, if you're looking at the IRR, everything depends on the early cash flows. Those out-year cash flows, even if it's a relatively low IRR, don't matter. If I use a 6%, then you have the big difference in cash flow still. If I use a 6% discount rate, again, I just get my 6% back. I used a 4% risk premium, and you can see the bigger, much bigger risk premium that occurs. I suppose this would be 4, and about 4 is 8% down here, instead of the 6.5, or is it less than 8%? This would just be 4%, kind of like this one. So it went from 4 to 8% instead of 4 to 6.5%. Not as bad. But that's why that Africa, I call it the Africa problem, really highlights the issue. Okay, and that's it for this one. So now, my next video, I'm going to go through the torture of making that other, doing that other analysis.